What's up, team? This is Yates from Denver, Colorado, and today we're going to talk about what you need to have planned out and what you need to do before you enter a position trade that you're going to pyramid into. So let's get started. Let's dive into these charts a little bit and go over the basics that you're going to want to know before you get into a position trade. The first thing we'll go over very quickly is what a pyramid is. A pyramid is basically how you get into shares to reduce your average price. You're going to get into a little bit of shares at the top and a lot of shares at the bottom, basically making this pyramid shape. So if you get into 10 shares here, 20 shares here, 30 shares here, 40 shares here, your average price is actually going to be right at this 69 price. So that will help you get a better dollar cost average when you're taking these trades. So when we're talking about pyramiding and position trading in this video, that's what we'll be talking about. So the first thing that you want to know when you're getting into a position trade is going to be what stock you want to enter. And when you're picking your stock, you're going to want to get into a sector or industry that you like and a company you like, some company that you know how they make their money, that you know what they do, and that you have conviction and perspective on, that you know it's going to go higher over time because it's a good company and it will continue to grow and make more money. The key to doing this, or the reason for doing this, is because in position trading, in these kind of trades, we're going to be in the stock longer. We're going to stay in these trades for sometimes up to a year, even longer if you want to, and if you're a more longer term trader, you're going to stay in these things for a long time. So you really want to know what this company is going to do. You want to have a good perspective on, this is a good company, even if it's down, even if I'm down on the position a little bit, it will go higher in the long term because it's a good company that people like, that makes money continually, and it will continue to grow in the future. So that's really important. It's much more important than if you're just taking a swing trade for a month or two or a week or two, because you're going to be in this a lot longer. So the second thing you're going to want to do is determine your position size. That's going to be your risk. That's going to be the total amount of money that you're going to put into this stock in this entire position. So from the top of your pyramid to the bottom of your pyramid, from here to here, how big is this position going to be, and how much money are you going to get into on that position? I like to look at these when I'm entering them as an absolute zero play, meaning that if the stock goes to zero, that's how much I'm risking. So if I bought $7,000 worth of this stock, which is what we're doing in this exact example, it's actually $6,900, then I would be risking that exact amount. So that is my risk. Even though if I did a good job on step number one, it's very unlikely for that to happen, but that's how I like to look at it to keep a good outlook on this trade. The next thing that you're going to do is determine your entries. You're going to want to base those off of the chart, and you're going to use support and resistance, moving averages, candles. A lot of different things can be used on this. You can use fib numbers, you can do fib retracements. A lot of things can be used to determine those levels, and that's going to be your preference. But you want to determine those levels ahead of time. I determined these levels here based on the fourth one being right at the simple moving average. The 100 simple moving average on a daily chart is where I want to get into my last amount of shares if the stock would go down to that price. It's not necessarily going to. It might only fill you on your top two pyramids and then bounce and go higher, and you don't get filled on your last ones. But if it does go down to that price, that's what you're determining where you get into all of those entries. You can determine as many legs or tiers, meaning these lines here, as you want. You could get into 4 like I have here. You could get into 3, you could get into 10. It's really up to you. That's just something that you are going to want to determine ahead of time and figure out how many shares you're going to want to get into at each price. On this example, I have 10, 20, 30, and 40 shares on each level. You can do that a lot of different ways. You can that equals 100. So I could also do 20, 30, and then this last one's 50, and I delete this top one. So that would be 3 tiers getting into 100 shares. And so that would be, you would just have less entries, and it's just up to preference at that point. Another way to do it is a math-based formula. So if I decide I want to get into $7,000 worth of shares, and I want these to be my entries, and I want those basically divided evenly, what you can do is you divide 7,000. So let's type this out real quick. So you can divide 7,000, which is the number of shares you want to get into, and you divide that by 4 because that's the number of tiers we want to be in, is correct? So 7,000 divided by 4 entries, and then that equals 1,750. So that's how many dollars we want to get into of each tier on each level. So then what we do is we just divide that 1,750 by our stock prices on the side here. So 81, 75, 69, and 63. So our first tier, 1,750 divided by 81, would give us about 21 shares for our first level. Our second tier would be, so let me write this out, divided by 81 would be 21. Our second tier would be 1,750 divided by 75, and that gives you about 23 shares. Our third tier would be 1,750 divided by 69, and that gives you 25 shares. And then our last tier would be 1,750 divided by 63, and that gives us about 28 shares rounding up. So that would be another way to figure out your tiers. And so this 21 would go here, 23, 25, 28, and that gives you a more even pyramid. So it doesn't really get you into a lot of shares up top and a lot at the bottom, but it gets you into exactly $7,000 worth of shares. You can change how much you buy and make it less even so that it is more of a pyramid. There's lots of ways to do it. Those are just 2 examples of how to get into those shares. So if you want to tweak those a little bit, the most important thing here is to determine that before you're getting into the trade, so that you know where you're getting into it, the trade, how many shares you're getting into the trade before you even take it. So if the trade looks right here and I'm setting up these positions, I know exactly where I'm going to get in. I'm going to leave these open until I get filled on any of these. And if it does just run up to 110 or so, then that's where I would cancel and I'd reevaluate. But you also do want to know that number as well, where you would cancel this trade. But I would leave it open for about a month or so to see if you can get filled on those trades. The next thing you're going to want to do is plan your protection. So you're going to want to know what you do if the stock continues past your bottom tier. So I have a protective put here at the bottom because I'm getting into 100 shares. So if it breaks below this level, I would buy a protective put here. If you have 100 shares, you can do that. If you don't have 100 shares, like if you're pyramiding into Shopify or Amazon, or a stock that's going to be really expensive to own 100 shares of, a couple things you can do is you can still get into a protective put, but it's going to be very expensive. So it might be better to actually scale out of your position as it does go higher. So if it does break above your average price, you can scale out of some of that, and then you can just have a smaller position if it does continue to go lower. So if you get a bounce and it comes up, our average price on this exact trade would be $69. So if the stock came down and we were wanting to protect and we didn't have 100 shares, came down and it bounced up a little bit, we could scale out of a few shares, and in case it was going to roll over and come back down and we didn't want to get into it. Another thing you can do is get into a collar, so you can sell calls up high if you do have 100 shares, and you can buy puts, and that's going to be a collar. You're going to protect your position. You're not going to spend as much on your insurance as you would if you were just buying a protective put. And so you're going to want to plan where you get into your protection and how you're going to protect your plan or your position before you get into that. And because if you do that in the moment, a lot of emotions are going to get involved. You're going to feel scared. You're going to feel like you made the wrong decision even getting into this trade. What are you going to do? You're down on it. So you want to know those things ahead of time so that all those emotions do not come into play, and you're just following your plan. You're getting into your protection. You're scaling out. You're doing whatever you need to do to protect your downside on these plans. It's very critical that this one is decided ahead of time. So number 4 is plan your protection. Number 5 is plan around earnings. If you know, if you know you're going to be in a company for more than 3 months, you're going to hold over earnings. So you're going to want to know what you do over earnings. You can do a couple of the same things that we talked about with the stock going lower and protecting. You can get into puts, you can get into callers. So you can sell a call up here and you can buy a put down here as your insurance, and you can, so this would be a protected put sale, nope, where's protected put, so you're buying a put down here, I guess I already had one, buying a protected put down here, and you're selling a call up here, so this would be a covered call, so that you're getting into a collar is what's that called, and you're holding that over earnings. So you want to make sure that you're in some kind of protection over earnings. You can also do the same tactic as we talked about before, is you can scale out of a position. If you're up pretty big on a position and you're coming over earnings, you can sell a few shares just to reduce your cost, lock in a few gains, and then wait till after earnings. If it gaps down, you buy those shares back. If it gaps up, you continue to hold the shares that you were in. So those are a couple of ways to protect position. And that's what's over earnings, to protect position over earnings. And that's one thing that you're going to want to decide ahead of time, because you will be in these positions over earnings if you're holding for longer periods of time. And the last thing is going to be, where do you take your profits? And there's a couple different ways you can decide this. You can just determine a number, a level that you want to get in, you want to get out of the trade at. So say I do get filled on every single one of these and it bounces and I nailed it. I could just pick that I want to get out of this trade at 120. So I could just say, this is my level, this is my target. Oh, no. This is my target. And you sell everything at that position right there. And you just wait until it hits there. You protect your downside, you continue to watch earnings, and you just wait until it gets up to that point. So you get in at 69 as an average cost, and you get out at 120. You take the nice win, and then you move on and you do it again in another stock. Another way you can get out of a position is you can pyramid out of your position, meaning an upside down pyramid. You can get out of a little bit here, and then you can get out of a little more, a little bit higher. You get out of a little more, a little higher, and you can get out of your whole position a little bit higher than that. So that's another way to get out of the trade, and you can set that up as well. You do want to have that target. And one thing when you're putting your targets together is know an approximate time frame of when you want it to get to your target. If it doesn't get to your target, you can then reevaluate, formulate your plan at that point, and put that into your notes that you want this trade to reach 120 before July. And if it doesn't meet that before July, you're going to reevaluate. Maybe they'll move it up if you're really close to it, and you'll just keep protecting that downside. Another option is to sell covered calls on your position until you get called away from the stock. And so you would, if you have 100 shares, you could just sell covered calls out of the money and just keep doing that until you finally do get called away in that position. So those are just some basic ways to get out of position if you're and you want to have those set up so that you are taking profits at a level that you decided before you entered the trade. So just to run through them once more, you want to find your stock, you want to figure out your size, which is your risk. You want to figure out your entries that are going to make your pyramid. You want to figure out where you're going to get into protection, how you're going to plan around earnings, and where you're going to take profits on your trade. These are all 6 things that you're going to decide before you get into your position trade, and that will help you out a lot to keep your emotions out of your trading, which is one thing that is very helpful, very useful, and very needed on any trade. Well, that's it for today. For more stock trading education, visit reallifetrading.com, and I will see you next time. Thanks a lot.